All right, everybody. Here we go. Sorry about that. So, right, Lighter Capital, who are we? We are an alternative finance company. We're not a VC. We're not a bank. We lend money to early-stage software and technology companies. We use a unique model that's best suited for entrepreneurs, we think, in today's SaaS economy. It is a revenue-based loan. So it is technically a loan that gets repaid over time, but it features a lot of structures that are really friendly to entrepreneurs and to companies that are growing and early. And I certainly will talk more about kind of our structure down the road. That we're a company of serial entrepreneurs, technologists, angels, and former VCs. So we've seen all sides of building businesses and raising money. We use technology on our own end to speed up the underwriting process and make fundraising fast and efficient, get you back to building your business and not spending a bunch of time in coffee meetings. And I think that's about it on us. I'll talk more in a minute. Like I said, we have provided capital to 10 ISVs on the App Exchange at this point, and SIs for that matter as well. And our model works really well with ISVs on the platform, and can talk more to that down the road as well. At this point, I'd like to introduce Sirk, my guest today. Sirk, I'm so glad you could join us, and please introduce yourself.
Thank you very much, Rob. Good morning and good afternoon, everyone. I'm thrilled to be here presenting with Rob and the Lighter Capital team. We're great partners. Lighter Capital is a great partner of many of our clients when they look at different types of fundraising and capital infusions. Just a little bit about early growth. We are a Bay Area based company, but we have offices kind of throughout the rest of the country. We focus on small and mid-sized companies, and our big niche is actually in the early stage, as you can tell from our name. But in the early stages of tech companies, typically in the Series A or even before in the seed finance company, where the requirement for accounting and financial assistance isn't so great that you would be looking to hire people full-time or even part-time. We work on basically an hourly basis on a go-as-you-go and go-as-you-grow model, and our partners and our client base is very, very appreciative of the expertise that we bring to both the accounting and financial assistance as well as CFO level services. And as you can see, we are one of a very, very fast growing company here in the Bay Area as well as in the rest of the country.
Yeah, and we're excited. We work closely with Sirk and the team because it's a great fit to have a team like them in place in the company to help get things organized and help the company grow on the back end, back office side too. So it's like Sirk said, a great partnership. So today, what are we talking about? First off, we want to have you reflect on your own business, sort of know thyself. What kind of company are you? What are you building? How does everything work internally? And then that's an important piece. Like I said, we did another webinar that I encourage you to go look at as well on funding options, and that might elucidate some ideas for what type of funding is a good fit for you as well. And then projection, what do you need to present to a potential investor going forward? Preparation, pulling it all together, and then lastly, documentation, which is sort of nuts and bolts. We're going to spend the majority of the time on the first three. The last one's sort of a laundry list, but I think it's also a really important resource for what specifically do you need? What is an article of incorporation, or what's the difference between an article of incorporation and a membership agreement or something like that? So we'll talk about that a little bit. So reflection. This one's really important and is where we especially spend a lot of time talking to companies, trying to better understand the fundamentals of the business. So having you fully understand your own fundamentals really helps prepare you for fundraising and what type of capital you might want, what size, what time, and what cost, right? So what stage is the company? There's a very different fundraising strategy if you're pre-revenue, pre-product, versus if you're a $10 million revenue company that's cash flow positive, right? What is the revenue and the pricing model? This is particularly important to us, less so to other investors, but particularly to a revenue-based lender. We want to know what the revenue model is. When do you get paid? How much? Is it subscription? Is it one time? Is it services? Is it license and maintenance? That kind of thing. And then certainly current existing financing in the business is going to dictate a little bit of your path going forward, right? There's certainly flexibility there, how you financed your business to date is important. Customers, who is your customer? What's your sales model? How long is the sales cycle? How expensive is it to attain a new customer? How long do they last for? What's their sort of lifetime value? All of these important metrics that you probably heard about. Having that worked up is really important. If an investor asks you what's the lifetime value of a customer and you have no idea, that's usually a bad sign, right? You need to have a pretty good sense of who your customer is and why you're trying to serve them. And then that stems down into sales and market. We look at customer concentration pretty closely, so we like to know how big your biggest customer is, how much of your revenue is driven by your largest customer or largest 5 customers. And then certainly going forward, we'll talk more about forecasting, but the pipeline. And lastly, team. VCs especially like to look at team, and it's okay to have holes, just you need to know about it because the use of funds is certainly to fill that hole. So who do you need to go hire, why, when, and that kind of thing. Sirk, do you have anything to add on this slide?
Yeah, a couple of things. I think that the main focus here is I think most of this information you either already know or are very, very familiar with. On the financials, I think Rob kind of pointed to it a little bit, but there is a big difference in terms of actually how much you spend versus what the cash flow is from that model. And understanding that is really, really critical to understanding your business and understanding your financing needs. And then on the customer side, I think that this is where some companies do get hung up a little bit because they really don't fully understand the customer acquisition cost or their lifetime value of a customer, and really being able to not only identify and calculate those types of numbers, but really be able to communicate that as you're going through the fundraising process will be very, very critical.
Yeah, that's great. I think it's important to, again, kind of self-awareness. I think being able to communicate it and highlight, I think shortcomings are okay. Like I said, with a team, if there's gaps, that's actually really a benefit if you know that there's something you can improve on. Your margin can improve if you do X, Y, Z, and you want to raise money to do that, right? So being aware of those things and communicating both the positives and where you see opportunity.
As well as team, right? Hiring, critical people. One of the things that investors are always wary about is when someone comes in and says, we've got the full team in place to do everything that we need to do. Then the question comes up, well, then why aren't you doing it, and why do you need more money? So so that is you should be looking to hire, right? If you're looking to fundraise, part of that money should be going towards hiring. Maybe a significant amount of that money should be going towards hiring, and you should be able to identify where those gaps are.
Yep. Great. Projection. So this is where Sirk and his team are particularly powerful. They've done a lot of this for companies over time, and we love to see a well thought out plan. Certainly not a requirement to have a full-blown projection for us, but we definitely like to see thought about it. And so Sirk, I'll let you lead this one because it's a little bit more in your wheelhouse.
Yeah, and you can see some of the questions there, but really, I really like to focus on the last bullet point, which is milestone financing. So, if we take a look at kind of what you're trying to do in terms of fundraising, you're obviously fundraising for a reason, but you should be thinking about, okay, how much money am I trying to raise, and what am I trying to achieve? Because we as entrepreneurs, as our companies, the valuation of our company is not a flat line. It's not a curve. Instead, it will go in big step functions, right? And those step functions in terms of big increases in valuation are going to happen at certain milestones, whether it's product development, whether it's customer acquisition, whether it's number of eyeballs, whatever it may be. Those milestones that are critical to the success of your company, hitting those milestones with each of the financings that we're trying to achieve is what's going to enable you to keep most of the company, keep more of the equity in your company as you raise financing. And so, this is a place where I say you got to look at all your options, right? Obviously, VCs, angel investors, equity financing is a critical component of that. But with those, you're going to be giving up a fair amount of equity, maybe a large amount of equity. To the extent that we can increase our runway, get money in the account in the company without giving up equity, and still allowing us to hit milestones, get bigger traction, is going to be critical in terms of your ability to hold on to as much equity of your company as you can as you grow.
Yeah, and I think this one is really alignment of what you want to use the money for and what kind of money you're raising, right? I think, and that goes to the milestone financing, right? If your goal is to go from zero, pre-product, to having a product and having some beta customers, you know, friends and family is probably the way to go, or self-financing, credit cards, that kind of thing. If you're an existing company with 10 employees and you want to turn into a 30-person company that's doing 20 million in revenue, if you want to do that in a year, that's probably venture, right? If that's your long-term goal, if you want to exit for a $30 to $40 million exit and you want to grow probably over the next 3 years to that point, there are other cheaper ways, you know, one of them being revenue loans from us. That's why we started this business, and make these investments in companies to finance your business and maintain that equity, like Sirk was saying. So, and you know, again, the other piece too is cash flow, right? If you plan on burning lots and lots of cash very quickly to get to some milestone that's very critical, whether it be eyeballs or it be number of customers, or you know, a product launch, again, that might be equity. If you want to burn deficit spend, do some marketing, some sales, sponsor a conference or two, you know, as we all know, Dreamforce sponsorships are not cheap. You know, that could be something like a debt raise or a angel round or something like that, and then away you go, and you're growing. You know, maybe you've doubled in size or something like that. So keep in mind those milestones and how they relate to what type of financing you might need, and what the scenario is with your business as you're growing. Whether you're break even, whether you're burning lots of cash, whether you're burning a little bit, et cetera.
That's right, Rob. And if you kind of combine, you know, the data on this slide with the one from before, the kind of know thyself slide, and if you are familiar and knowledgeable about the different types of financings that are available and different types of cash infusions that are available, then I think, you know, some of the answers will kind of, you know, it'll be pretty obvious some of the things that you should be looking at, you know, for the specific situation you're in.
That's right. Good. Okay. So we've kind of hinted at these things, or you know, danced around them a little bit. This is, whoops, getting ahead of ourselves there. This is a one piece of the deck that we did just a couple weeks ago on funding options. So I'll do a very high-level overview of this. This is the various funding options available for different companies, and it's a rough estimate, but it gives you an idea. So as I mentioned, when you're first starting out in the garage, bootstrapping. I'd like to clarify bootstrapping and self-funding. Bootstrapping is basically growing organically or using the revenue generated from the business to grow. Self-funding is when you're plowing your own money into the business, right? So those are a little bit different. One is sort of negative, and one is break-even, right? Friends and family, angels, incubators are great. We've been working with a lot of Canadian companies. There's some great programs in Canada, some government grants and things up there. And then once you've got kind of off the ground and you've got a little bit of traction, some revenue, a product and market, some customers, some other things start opening up. Certainly those other options still exist, and they can be pretty cheap sources of capital. Friends and family is usually pretty good, although it comes with a little bit of social cost, perhaps. We've all heard horror stories. But revenue-based financing, at least the structure we use, we can lend to companies that are doing at least $15,000 a month in revenue and up. Usually up to about 5 to 10 million is the top end of where we lend. But if you've got at least 15K in revenue, and that can be from services as well as from product, we can possibly do a loan of 50 to 75K and help you hire a salesperson or hire a dev and grow. VCs, I think it's a little bit of a misnomer that VCs invest in pure startups out of the garage. There's very few that actually do that. They usually like to see a product and some revenue. They can get involved pretty early, but most of them are actually, they want to see a fair amount of traction before they get involved and then pour the fuel on. Later on, you've got strategic investors like Salesforce.com. Everyone has heard probably that Salesforce does make direct investments. They're called, you know, quote unquote, a strategic. You know, Cisco or Oracle will make investments from time to time in companies. And so when you have a little bit more traction, or if you're in a particularly interesting industry segment, the strategic might take interest. They have a lot of strict. Usually, they have some pretty strict investment guidelines. Like I know in fact, you know, Salesforce won't lead a round, and they'll only take a very small amount of the round. So they're participating, but they're not going to be the majority investor. They're not the place to start anyway. They might come in on an investment. And then down the road, when you're closer to break even, banks will certainly look to make investments, but they really don't get involved until you're a pretty well-established company doing several $1 million, pretty good track record, and break even. Sirk, you've probably seen at least several dozen of each of these. Anything to add on these?
Yeah, just a couple things. I think you summarized it really, really well. You know, friends and family, we always say, and I always want to just point this out, even though it's probably pretty obvious to most of you. But just be careful, you know, and make sure that the money that you're taking from friends and family, they understand that it is really, really risk capital, right? And that there's a, you know, there is a chance, and it may be small, it may be great, but there is a chance that they may lose 100% of it, and that should be okay. And that if that happens, that shouldn't impact the relationship that you have with them. You know, money will come and go, right? We're going to new ventures, we're going to get money elsewhere, we're going to make a lot of money in our lifetimes, but our friends and family are sacred. We should preserve those relationships as much as possible. So, you know, if you're going to take money from friends and family, make sure that the expectation is set up front, and that the risks are fully understood. On the VC side, you know, I'll echo what Rob said, which is that VCs, you know, we hear these stories about them putting a lot of money into early stage companies. That is getting less and less usual now. They are, as Rob said, wanting to see more and more revenue, and to the extent that, you know, kind of going back to this whole thing about milestone-based and traction, we want to get as far along the line with this other type of financing, whether it's bootstrapping or self-funding or angels and incubators, and with other tools like revenue-based financing. We want to get as far along the line and get as much traction as we can before going to VCs, because we give up not only in terms of equity, but also a lot of control once we bring VCs into the fold. And you know, I always tell people, look, if you can do it without VC money, let's do it without VC money. Because you'll just be better off. The times when you should be looking at VC money is when you see an opportunity to really, really grow, and you need a pretty large cash infusion to either hit the market, you know, in the time frame that you have, or to really, really accelerate your growth because you see a huge opportunity.
That's great, Sirk. Something you made me think of that I'll add, the sort of the light blue stuff that happens very early often happens kind of light and fast and without thinking through fully, which is totally fine. I echo that you want to think it through from a relationship standpoint, but also a little bit from a company standpoint, right? It's like, okay, Uncle Bob's going to write me a $200,000 check. Great, I deposit that and away I go. Well, 6 months later, you go talk to a formal institution, and out of nowhere pops this $200,000 investment that's completely undocumented, and no one's really heard from Uncle Bob in a while. You know, I would just urge you to also be thoughtful about, you know, that's a formal investment and it needs to be structured. It doesn't need to be formally documented. Keep legal fees down, but certainly keeping in mind that it's not just a hand wave. You know, to you it might be a hand wave, like, oh yeah, I see him every weekend at a barbecue. A formal institution is going to want to know what the story is with that. What's the repayment schedule? What's the rate? What's the maturity? When and how can he call the loan in, or whatever it is, or is it equity? Is it not? You know, how much was you know, how much equity did he get for it? That kind of thing, and that comes into the documentation down the road. I know early stage, you know, we're all just trying to go as fast as we can and grow, and not worried too much about the details. But this is where something like Sirk's team can really help get all your documentation and to be kind of formalized for a true institutional raise, whether it be from somebody as lightweight as us. You know, we're pretty lightweight on the end of the spectrum, where the VC is going to want to see very concrete documentation. So you have to be thoughtful even in the early stages when you're not really sure even what you're doing, you know, out of the garage. But it does impact the future for sure.
Yeah, and it's simple, right? I mean, it's not an onerous activity at all. You know, you could even just go online, you know, and look at, for example, you know, a template for a promissory note, right? Which is all you really need. You know, you may actually try to, depending on how I guess complicated it is, or how many investors in terms of friends and family you're bringing in, you may actually set it up, you know, with a little bit of legal assistance to set it up as like a convertible note, right, that may transfer into equity in that next round of financing, institutional money. So, you know, it's different, but as Rob says, you definitely do want to have it papered, even if it's a simple half-page promissory note document that says, hey, you know, Uncle Bob is lending us $200,000, and we're going to pay a interest of, you know, 4% or 6% or something minimal, and then it's either going to be repaid back at some date or it's going to be turned into equity.
Yeah, you know, that's really important, that just for you as well, right, that you've got, you and Uncle Bob are on the same page, right, and you've, you know, worst case, forget us for a minute, you know, coming in later on, if something goes wrong, you know, you guys want to have something you can point to and say, hey, we agreed on this, this is the situation.
Absolutely.
Okay, let's move on. So quickly, let's compare. You know, Sirk actually mentions that not only are you giving up equity, but you're also giving up a lot of control with a venture capital firm. They don't have much in the way of covenants, ways to protect their investment. So the way they work around that is by requiring a board seat, asking for preferred shares that come first, those kind of things that Sirk mentioned, the controls that go along with the investment so that they can protect their investment. Banks do it through covenants. Obviously, you can't, you know, raise additional debt. Sometimes there's personal guarantees. We don't require either of those things. We have some financial covenants, but they're not like ratios. You know, you must keep your current ratio XYZ level or anything like that. Added value. This is where venture capital really shines. This is what they provide, right? Their venture capitalists are former operators, right? They have tons and tons of experience and a deep network. So this is where they really shine and add value. They mentor entrepreneurs, help them grow, introduce them to strategic partners, future investors, the whole nine. This is where their value is. This is what you're paying for by selling equity. Banks tend to be very low on this end. You've got a relationship manager that will help you out and help you with banking needs, but that's about it. We're somewhere in the middle. We can be sort of dumb money, if you will, but we also are more than happy to be fairly involved. Again, we don't take a board seat as we don't have a direct role. But we've looked at VC term sheets for some of our portfolio companies and helped them sort of sort through next steps. We've worked with lots of companies in the Salesforce ecosystem and working with Salesforce with them and helping them grow there, that kind of thing, or introducing companies to Salesforce if they're interested in software and they want to build on the software on the Salesforce platform, that kind of thing. So we can be fairly active or relatively quiet. Dilution, this is the negative to the venture capital model, obviously. They tend to take quite a bit of equity, right? I think the average is Series A is usually in the 30 to 40% of equity range. Series B is usually 20 to 30%. The Series C is usually 10 to 20% is what I've heard. Banks tend to take, you know, almost none. They might have warrants in some of their high-risk deals. We also have a success component, but it's fixed, it's capped, it doesn't participate. It is not it's not an equity piece. It's a small extra fee bonus if you are acquired while the loan is outstanding. Flexibility. We are this is a hybrid, totally a hybrid. Obviously, VCs are totally flexible. You have no repayment until you have the big payment at the end of the day. Banks are completely inflexible. And this is where most people get in trouble with banks because of the inflexibility. We're somewhere in the middle. We require monthly payments, but they vary with your revenue as your company cash receipts go up and down each month. You pay more or less. And then speed, this is where we really shine. We've built technology here to speed up the underwriting process and just get you back to building your business and off the fundraising path. You know, no one wants to spend six months doing coffee meetings with several hundred people. And banks tend to take quite a while to underwrite a loan as well. Sirk, anything to add here?
Yeah, a couple things. I think that the speed thing is absolutely critical. I mean, we as entrepreneurs, you know how critical your bandwidth is, right? And you need to be focused on the things that are going to continue to add to the value of your company, and that's typically product development, customer acquisition, sales, and marketing. Financing tends to be a necessary evil. That we would love to spend as little time as possible doing, and so to the extent that we can speed up the process of getting cash in the door, that's obviously a great thing. I think this 3 to 6 months focused effort on venture capital, it could take 3 to 6 months. It could take a whole lot longer than that. And usually when you're going after VC money, it requires at least one of the founders to be basically focused 100% of their efforts on that effort, just on their own. And so that is just something that you need to consider. And then the other thing that I'll say is that from a financial planning perspective, we really appreciate the likes of revenue-based financing just because of the fact that it gives us a lot of flexibility, and it's also something that we're able to model out easily, and we're able to do sensitivity analyses on them such that we can see, okay, well, this is what happens to our cash flow depending on what happens with revenue and the impact that we have not only on our internal cash flow, but then the repayment schedule. The difficulty from a venture capital perspective is the whole thing. It's very easy to model out, but it's very, very difficult to anticipate kind of what you're giving up in the equity side of it, and it could be a great deal for the entrepreneur. It could be a horrible deal for the entrepreneur.
That's an interesting point you make. I was talking to an entrepreneur not so long ago. So we often do multi-tranches too. We'll give you 100K now. As you grow, you've doubled in size. We'll do another 300K. So on and so forth. We've done at least 2 tranches with over half our portfolio and up to 4 tranches with a couple companies, and with no end in sight. They keep growing. And one guy approached us actually recently, and he's got, I think, 4 tranches built into his model over the next 12 months where he's going to do, he only wants 75K now to hire one guy, and then he's got the revenue modeled out, and then he knows he wants another tranche, and then he's got it all modeled out. So yeah, you're right. It can actually fit into the planning of the growth path quite well. It was pretty impressive. It was pretty interesting. Okay, so very quickly, if you haven't gotten the picture by now, the repayment structure is a fixed percent each month, and so you can see the blue bars are your revenue up and down, and to be specific, it's cash receipts actually. So that's why I said back on the first slide that we spend a lot of time looking at cash and customers and revenue model. Because it's actually based on cash receipts, which is to your benefit, right? You only pay when you have cash. And then the black is your payment. So it's a fixed percent of that revenue growth over time. And that goes until we've received VCs and angels always talk about sort of the 10x. They're looking for a 10x return. That's their goal. We work the same way. It's a multiple return. There's no interest rate and there's no term. This goes until we've received a multiple, but our multiple is 1x. That we ask for. So if we did a 100K loan, your total obligation would be 200K. And then we structure that royalty amount to be quite small, so you pay us out over about a 5-year period. So it's long-term growth capital, 1x return over 5 years is the goal. So again, saving on cost of capital and saving on dilution. Okay, so we'll just provide that quick overview so you guys know more about what we're talking about with revenue-based finance. But now this is sort of the key piece, I think. And Sirk, I'll let you start this one, as you guys do a lot of work here, and it's really important and powerful stuff.
Sure, sure. Thanks, Rob. So yeah, it's basically just being prepared, right, and getting ready to talk with investors and whoever they may be. But it's it's putting together a 20 to 30-second elevator pitch. This is that classic where you're stuck in an elevator going up 2 or 3 floors, and someone asks you what you do. And here we just say, look, it's not. Don't give a description of your company or your product. Instead, talk about your vision, talk about your passion, talk about the problem you're trying to solve, and pique interest, because that's really all you're trying to do. You're trying to have them be interested and ask you a question of, oh, tell me a little bit more about it. Executive summary should be a 1 to 2 pager that goes a little bit more into detail, describes your business proposition, something that you can send out to a potential investor or to a lot of potential investors to see if it fits kind of within their investment guidelines. And all you're trying to do again is to pique enough interest, show that you've thought it through enough, so that the investor will call you back or will take your call when you follow up with an email or a call afterwards. Obviously, you need to have a financial model and a budget put together. You should have a product demo prepared. Those aren't things that you're obviously going to send out initially. The final thing is obviously the pitch deck, and we can kind of maybe go to the next slide and focus on kind of what's in your pitch deck. But it's and there's lots of examples on online that you could take a look at. But what we try to say is, look, you need to keep it to 10 to 12 slides, right? And if it takes you longer than that to explain it, then you got too much information. You should obviously have backup slides for when you're actually doing the presentation, or when the investor is looking for additional data or going through their due diligence. But your initial pitch deck should be 10 or 12 slides, and it's something that you should be able to give the presentation in about 20 minutes. Because this is what's going to happen. If you're actually sitting down in front of an investor, or a VC, for example, they'll give you an hour meeting, and then they'll be invariably late. They'll typically walk in 10 minutes late, kind of keep you on hold, and then once they come in, they'll say something to the effect of, really, I hate to rush you, but we've actually got a hard stop in 20 or 30 minutes, and so can we kind of keep the presentation to that length? And they do this because they see too many pitches where in the first 5 or 10 minutes they realize it's just not their cup of tea, and they don't want to waste time, neither theirs nor yours. If they're really interested, they'll actually give you that full hour. But you should be able to go through your presentation in 20 to 30 minutes. And it's building a story, right?
Can I jump in here and add a little color to this? I think this is an amazing slide, and these are your 10 slides, right? And I want to really highlight something. This is a great slide because it gives you the 10 slides for your pitch deck. The middle bullet here, I love revenue-based finance, and I love talking about it, but I also need to make sure that I talk about how it fits into the greater ecosystem, right? So obviously you heard me talk a little bit about that today. I could do an entire presentation about just revenue-based finance, just our product, right? But it's really important that when you're presenting to an investor, you wrap not just the solution, but you have to wrap it into all these other things and why it's an interesting story. I've often heard pitches that are just product pitches. And the product is great, but they don't just sell themselves, right? They've got to fit into the rest of this stuff. So you've really got to make sure it's just a piece of the puzzle why your company is a great opportunity, not just the product itself.
That's right, and it's got to be a story, right? So the whole thing kind of has to weave into a story of, who are you, what's the pain point, right? And actually describe the pain point, the pain that you felt as an entrepreneur and why this is a passion of yours. And invariably, if it's a big enough problem, then some of the investors have seen it too or have experienced it as well, and they'll nod their heads. Talk about how you're going to solve that and what the opportunity is going to be, and then the rest of the stuff. But it's really about weaving a story, being able to present it in 20 or 30 minutes in a 10 to 12 slide pitch deck, and being able to send that out and then be able to talk in between the lines of the actual bullet points when you actually get to the presentation.
And this is where helping put this stuff together along with the models is where Sirk's team can really help you guys. They've seen so many of these, far more than VCs, right? So they've got a lot of experience with this stuff. Okay, let's keep moving on. So planning your business. This is a great slide.
Yeah, I don't want to spend too much time on it, but it just basically comes down to taking a look at your financials, and you have to do it two ways. You have to do a top-down projection where you start with the TAM, the total available market, and you kind of start whittling that down and funneling that down until you actually get to a serviceable market. And then once you get to a serviceable market, what percentage of that can you take, and what percentage of that can you are you going to take over time? Right, and then that at least gives you a potential revenue number, and hopefully over a three to 5 year time period from a financial perspective. So you start with that revenue, and then you do a bottoms-up projection, and this is where I see a lot of companies do fall down a little bit when they're putting these projections together, because they do very, very high level, whether it's a percentage of revenue or percentage increases over month to month or quarter to quarter, and that's really not the way you go about doing it. Instead, you have to look at the revenue you're trying to generate, and you have to figure out what are the resources that I need to actually hit that revenue. What are the resources in terms of product development? What are the resources in terms of sales and marketing? What are the resources in terms of customer acquisition costs? What headcount headcount do I need? What other additional spending? Do I need capital expenditures? Do I have inventory, which I think for this audience is probably not the case. But in any case, all the cash that's going to be required, and figure that part out, and then that's going to kind of back into the amount of money that you're going to need, and the milestones that you're trying to reach with that money.
Great. Okay. Process. Do you want to lead this one off? I can speak a little bit about our process and how it relates actually to the business plan in a minute. Why don't you start with this?
You know what? I'm just going to focus on one thing here because I think you can read the rest of this stuff. The rely on your ecosystem, I think, is really, really critical. So, as an early stage company, you've already got a lot of a good network. You got the likes of Rob and his team, and they know a lot of people. Everyone that you're talking with are potential introductions to, or they should be potential introductions to either or an investor, a potential investor, or someone who knows a potential investor. And that's, all of your guys, like, your lawyer, right, should be a startup-based lawyer. Companies like, obviously, a little pitch for ourselves, but early growth, we work with a lot of VCs, a lot of angel investors, and we can help make introductions. Everyone that you're working with in your ecosystem should be a potential network opportunity.
That's a great point, and especially for this audience, your AEs. Ron's group is going to be, those guys, I've worked closely with them. They know so much stuff. They've helped build so many companies on the App Exchange. So really leverage your AEs, engage them, ask for help, ask questions, right? Don't demand things of them. Certainly, they're there to help you. They're your partners, right? You're an ISV. You're an independent software vendor, but you're a partner. But they are your partner. So ask questions, engage them. See how they can help you. Ask how they can help you. That kind of thing. Ask if they have suggestions for you for what you should be doing differently or whatever it may be. Down here at the bottom, we've got some recommended reading. Both Sirk and his team and I have similar mantras and some interesting things. These are 3 books here: Art of Start, Insider's Guide to Silicon Valley, and Early Exits, that all provide a little bit of a different view into building businesses and funding them and getting started, and then exiting also, and different strategies for when and how to exit and with what kind of fundraising in place.
Not the most colorful books, but the absolute must reading for every entrepreneur.
Yeah, and I think they're all relatively short too.
Yeah.
So yeah, good to pick up. Okay, so this is just the sort of laundry list of stuff, but again, a good resource for everyone. Oftentimes, I think we kind of snap. Oh, I actually wanted to, before we get to that, I wanted to say one thing about process. Sirk, I'm going to go back up 2 slides actually. So we've actually built our online process. 2 things. We actually have something in our short form where you just submit some information to start the process with us. It's actually called Elevator Pitch. So to Sirk's point, describe what are you doing in a couple sentences. But then we've also just built our technology on our side to basically help you do all of this electronically. You just fill out some forms, some sections of our website, and you've basically provided all of this detail to us in a very efficient way. So yes, the traditional way is a requirement for talking to VCs, but we think there's faster and easier ways to provide this info, and we actually use some APIs and things to grab some of it pretty easily as well. So in terms of process, we require all these things, but we try and, again, make it faster and easier for you to provide them to us, save you some time and kind of get us the answers we need. And on that point is documentation. So, like I said, this is a laundry list of stuff. By no means are we going to dive into each of these things, but wanted to provide a good set of resources for you so you know the full laundry list of things that could be possibly asked of you, so you have it prepared. And I think for at least for our target customer and sort of the audience today, like I said, we're building small businesses, we're going fast. Some of the documentation stuff is expensive on the legal front or just time-consuming and not that interesting. I'd rather get back to signing up and selling new customers or building more product, but it's required if you're going to raise money. Banks are going to ask for tax returns. They're going to ask for financial statements. We ask for monthly financial statements, and there's a lot of companies out there that don't do monthly financial statements. And so, somebody like Sirk's team can certainly help do all that for you and allow you to get back to building your business and things. So we've got each one of these. I can quickly go through them. I think we'll just scroll through and won't really talk about them, and maybe we'll start doing questions at this point. Sirk, do you have any other points you want to hit on before we kind of turn it over, or kind of scroll through these resources?
Yeah, this is a big laundry list, and it's a great reference for everyone to have. This is what, especially when you're talking with VCs, you're going to have to have all of this stuff. I think there's a lot of this that lighter capital wouldn't necessarily need, which is obviously another advantage of working with someone like lighter capital as opposed to potentially going to a VC or someone, even banks, right, require a lot more due diligence than what lighter capital is going to require. But it is a good reference for everyone to have.
Great. Cool. Okay. I think we'll just kind of scroll through. We got some questions. We have some questions, and we can. Like I said, I'll just sort of kind of go through some of these, and you can soak it all in, if you will, as we go through the questions.
So this is a question for you, I think, which sort of goes back to the preparation and the kind of information you need to provide when you're raising money. There was a question around competitors. How much detail do you need to go in? I know you talked about competitive advantages and stuff, but how much sort of detail do you need to go in about the actual competitors? Are the investors interested in that, or they just sort of want an overview?
Absolutely, they're interested in it, and it's for two reasons. Obviously, because they want to understand what the competitive landscape is, not only today, but who the competitors might be going forward, right? So, and one of the reasons why they want this information is not only for their own sake, but they probably already have an idea. If it's something that they're already interested in, if it's an investment idea that they're interested in, they probably already have an idea. You're probably just reiterating their thoughts. But what they're most interested in is making sure that you understand, right? You as an entrepreneur understand the competitive landscape. You understand, and part of it may be the reason that you're going after financing, right? You see competitors entering the field. You need to accelerate your market share or your growth to be able to ward off some of the competitive situations. And in many cases, even some of the bigger competitors might potentially be acquirers of yours, right? So yes, you absolutely need to go into it, be explicit about it, and I wouldn't go into a whole bunch of detail in your pitch deck, but you should absolutely be prepared to discuss it in detail when the question comes up during either the presentation or during due diligence.
That's great. Just want to remind you guys didn't make it clear when we started, you can chat your questions in. So just fill in the little chat bar. It'll go straight to us. Patrick's here. That's whose voice you heard a minute ago. He's our head of marketing. And we'll answer your questions.
And we have another one for you, Sirk. Do investors prefer to see a top-down projection or a bottom-up?
They want to, in the initial pitch deck, they're going to want to see a tops-down. They're going to want to understand what the revenue opportunity is. That's going to be the biggest thing. During the due diligence, they are absolutely going to want to see a bottoms-up, and they're going to need to see a bottoms-up from two perspectives. First of all, from a funding requirements perspective, so how much you're looking for and what you're trying to do with that money, but also, again, just because they are trying to minimize risk, and one of the ways that they minimize risk is by making sure that the entrepreneur fully understands their company, fully understands the competitive landscape, fully understands the marketplace, and the way that one of the ways that they determine that is to look at the financial projections that are being put together and making sure that they make sense. They're going to try to poke holes, prod holes into, and prod question you about your financials. You should be prepared to answer them and be able to back up the assumptions that you're using to prepare those bottoms-up projections.
Okay. Rob, this one's for you probably, but so you might have an opinion on this. What is it about the Salesforce ecosystem you think particularly sort of works for investors, or what kind of things, I guess appeal to us particularly from a revenue finance point of view, or just in general?
Yeah, so I'll answer this one. We did the webinar a couple weeks ago with Emergence Capital, who is one of the first investors in Salesforce itself, and has funded a couple of the ISVs as well. And I don't know if you all have heard it. We kind of have heard some VCs say, "Oh, the App Exchange. Well, that's a platform. I would never invest in one of those companies. They're on somebody else's platform." But obviously, Emergence has had great success funding companies on the platform, and we think the same. There's tremendous opportunity on the App Exchange. We see no problem with it, and several VCs don't as well. Salesforce itself is growing. It has a tremendous user base. With Force.com, Visual Force, and sort of OEM solutions, even Heroku and things, there's kind of no end. It doesn't need to be a CRM solution. It can be anything. One of our portfolio companies is an ISV that has legal document and IP management software. It has nothing to do with CRM. You can build kind of anything you want, and the potential market is not limited to the CRM or the Salesforce customer base. So we think it's a great platform, and have really enjoyed working with Ron and his team.
And here's, I think, another one for you, Rob. A bit more, I think, specific to RevenueLoan. What are the typical sort of minimum company metrics you're looking for to invest in a sort of Salesforce OEM partner in terms of MRR, churn, cost of sales, etc.?
That's a great question. So our main, I'll just talk through, I think our requirements for Salesforce partner is about the same as any other investment. Some unique things just because you're on the platform, but generally the biggest one is minimum revenue, minimum monthly cash receipts of about $15K. Certainly lumpy. Obviously, some of these are big sales, annual prepayments, so you get all your cash in 1 month. So we totally understand that, and we look at that closely. If you've got 4 customers and they each pay you a ton of money, but it's one time a year each, that's fine. We'll look at that. But a minimum of sort of, if you smooth it all out, $15K in revenue and up. We can finance some burn. You can certainly be burning cash and be, deficit spending. But the big thing, so big, deep burn is the land of the VC. If there's no end in sight to the burn, and you know you're going to need to fundraise again in 10 months, that's not for us. We're alone. We don't make enough money. We don't to take that kind of risk, right? That is what a VC does, is take that risk to make a big return. So we can finance some burn. We usually like to see our financing get you to break even, or at least 10 to 12 months worth of burn, and then hopefully to see those lines crossing at about that point. Those are the big ones. High degree of ownership from the entrepreneur, from the founders, is great. Existing debt is fine. Convertible debt is fine. We usually ask angels or individuals or friends and family to subordinate because we're the first institution in the deal. We'll subordinate to lines of credit and things like that. What other criteria do we have? Services revenue is okay. We like to see some product being developed or complete and in market. But especially, this is, I guess, where it's unique to Salesforce. If you're an SI or have a large part of your product as services, being on the App Exchange or being part of the Cloud Alliances program or something gives you a little bit of a leg up from somebody who's not, because we're familiar with the ecosystem and understand the revenue model and the customers and the implementations and integrations there. So we can kind of look at a little bit more consulting revenue than we normally would. I think I'll leave it at that. Happy to talk more after the fact. I think our contact info is here at the end, and so we can certainly talk more offline.
Yeah. There's perhaps a follow-on here, and Sirk, you might have a view on this as well. Do ISVs need to build on platforms in addition to the Salesforce platform to be attractive for an acquirer? E.g., does only being on Salesforce reduce exit options?
I don't think so. We have funded a couple companies that have built an awesome business and are ready to move to NetSuite or to Oracle or whatever, and that's where they want to go next. That's our growth plan. I don't think it's a requirement by any means. Sirk, I don't know if you have any view on how much you work with platform companies or not. If you want
yeah, no, I think it's all about revenue opportunity, right? And the trajectory of revenue growth that you have. So to the extent that you do it on a Salesforce-based platform, then I don't see any issue with that. Obviously, if you are able to take it out to other platforms and even increase the velocity of your revenue trajectory, then obviously that's better. But no, there's no limitations.
Well, we're actually almost out of time, so I'm just wondering maybe if you could just do sort of a just a quick sum, sort of major pitfalls, things to be aware of when you're sort of thinking about investing money. What would be, I guess, Rob, your top three, Sirk, your top three?
Yeah, mine is, what are my top three? So we see a lot of the well, I'm probably going to go raise $1 million equity round. And, I think that goes back to pretty much all of Sirk's points this whole time is basically why? What does that mean? And we hear that all the time. And, my big question is why? What do you want to use that for? Is that just, a number you're comfortable with? I don't understand that often. So would really urge you to think about why you want to raise money, what you want to use it for, and what the ROI on that money is for you. And then, kind of having your business in order, right? If you're, I understand, like I said, I've said this a couple times, that you're building a small business and you're growing as fast as you can. But it's still, you still need to clearly document salaries and investments and things like that. And then, don't forget there's other options out there besides equity. You don't have to sell equity. We think that there are, the SaaS business model has created a new asset class in the sense that subscription revenue is an asset, right? And we can use that as collateral to give you cheaper access to capital. So those subscription contracts are powerful, and use them to finance your business. Sirk? Yep.
I think those are great points. I really do. I think understanding your business, the fact that the SaaS model is relatively new, and that's why companies like Ladder Capital are able to be prosperous, is because they see this niche and are able to assist companies in this space. When I talked with my portfolio companies and our portfolio companies, and we talk about fundraising, it's things like, okay, be prepared, right? Be prepared for a fundraising effort. If you're going after VC money, it's a huge, huge commitment. If there's a founding team of 2 or 3, one of those founders will be spending 100% of their time doing fundraising efforts. Be prepared for that. Obviously, use your ecosystem as much as you can. One of the things, especially if you're going after VC money, this is something that I see some companies getting into trouble with. Be careful about spacing out your investor presentations. To be too great of a time period, because sometimes if you actually get a VC interested, they might actually put a time bomb on you in terms of an offer letter and say that you have 72 hours or 5 days to make a decision, and in the meantime you might have already set up a meeting with another investor. So that's a kind of a specific case, but that's something that I have seen happen. So be careful of that. And then finally, I'll just say that be aware of all the options that are available to you from a fundraising perspective, and match those options with what you're trying to do, how much money you need, how long you need the money for, and how fast you're growing.
Yeah, be prepared. I'll echo. Be prepared. Don't wait till you're out of money. That's a big one, right? You get zero leverage at that point. Plan ahead. Engage your ecosystem. Engage your lawyer, your service provider. Engage your accountant. And your financial consultant. These guys know a lot of stuff, obviously, and they have seen a ton of situations. So engage them early and often, and be prepared, and be successful. It sounds like, Patrick, there's a couple more.
Yeah, we've got a couple of questions that slipped in under the wire, so we'll just quickly ask those. Rob, do you have an interest in apps for the public sector space?
Oh yeah, absolutely. I know, especially because Salesforce is really pushing on that vertical right now. So I know that's a hot area for Salesforce, as well as just the market in general. Absolutely. A long sales cycle, but that's okay. They're very sticky contracts, and it's an interesting, unique business opportunity there.
Okay. And one more. We're thinking about moving from monthly to annual billing. In theory, this won't affect our revenue, as that's booked the same, but our cash flow will be dramatically improved. How do you approach this when funding companies through Ladder Capital?
Yeah, so that's what I was getting at, and it's really fascinating. Pricing and Sirk, I think this could be an entire webinar down the road for us, because I think you've probably seen some interesting things on pricing and contracting, because it does change your cash flow, right? From our perspective, right, your revenue is different, but you're going to get paid up front, so you can finance your business in advance, which is great. We just need to know, and we need to be able to model that and structure accordingly. That's it. So we dive into that pretty deeply it doesn't really impact anything too much. Assuming the rest of the fundamentals of the business are solid, it is beneficial. Upfront payments are great. Sirk, any comments on pricing and that kind of thing?
No, do it if you can. Obviously, get money up front if you can. And you know, I think you hit on all those points.
Yeah, and I'll tie these two together actually, because the public sector is interesting because they're bigger entities with sort of no end of life, right? You know, the federal government's not going anywhere. Often you can get really long contracts, even like 3 to 5 year contracts, maybe annual payments, sometimes even 3-year upfront payments, maybe with a deep discount. But you know, that's a great way to finance your business. That's pretty powerful. So I think that's about it. Sirk, I really want to thank you. Thanks for your time and your insights. Been a great hour sharing things with you and learning from you. And anybody, if you have any questions and you want to contact Sirk or you see our contact info and then our website's there.
It's been a pleasure, Rob. I appreciate the you giving me the opportunity. I appreciate the time that everyone has given of your precious time that you have. So thank you.
We'll send out the slides and the recording shortly. Thanks so much. Take care.